My name is Crypto Andy, and it is my privilege to discuss technical analysis with you. That being said, what is covered in this episode is for educational purposes only and should not be considered financial advice. Technical analysis is a method used to evaluate financial markets by analyzing statistical trends, chart patterns, historical price, and volume. It involves the study of price movements and indicators to make predictions about future market behavior. Technical analysts believe that past market data can provide insights into future price movements using various tools, such as moving averages, trend lines, and oscillators. Traders identify potential buying and selling opportunities. The goal of technical analysis is to help traders and investors make informed decisions based on the study of price patterns and market psychology. A must-watch if you are interested in learning about executing on a trading system is my video where I cover how to trade based on rules. Click the link above. At this point, you might be wondering, what are those price patterns and are they reflections of market psychology, aka fear and greed? Cryptocurrency trading is a type of financial market, and what plays out in the regular stock markets plays out in crypto markets as well. If you want to learn about the largest cryptocurrency platform, click on the link above to see my video on Binance. People do the same things and have similar reactions no matter who they are and where they are. The more whales come into cryptocurrency, the more mainstream it becomes. The more similar it will be to other markets because the players will wind up being the same. I will now cover some price patterns that are seen over and over in the crypto markets. Wedges are patterns that are characterized by converging trend lines where prices move within a narrow range. There are two types, rising wedges and falling wedges. Something that is seen when wedges play out are breakouts. Those breakouts can lead to significant price movements. In the lead up from March 2020 to the massive boom in November 2020, we saw there was a wedge forming in BTC and it broke up to the upside, indicating that there were more forward actions to come. Up next are triangle patterns. These patterns form when prices create converging trend lines, resulting in a shape resembling a triangle. Common types include ascending, descending, and symmetrical triangles. Breakouts from these patterns can indicate future price movement. We see with Ethereum that from April 2022 to May 2022, its price actions were in a downward triangle trend, which after it broke led to major downside. It's important to note that patterns in technical analysis are not textbook perfection, but they do play out, and sometimes after they happen, those patterns are obvious. Another good one is bear and bull flags. They are short-term continuation patterns that are commonly observed in technical analysis. They are formed after a strong price movement and indicate a temporary pause or consolidation before the price resumes its previous trend. We saw a bull flag play out in December 2022 to March 2021. Specifically, a bull flag pattern is formed by a sharp price increase, flag bull, followed by a period of consolidation characterized by parallel trend lines. The flag portion usually sees lower trading volume. When the price breaks out, the upper trend line is often continues the uptrend, potentially leading to further price gains. The pole drawn is used as the predictor for the upward price movement. It works the same with bear flags, only in reverse. A price pattern that I think may play out and is currently forming is the head and shoulders pattern, which is not as often seen as the others we have previously mentioned. This pattern consists of three peaks, with the middle peak, the head, being higher than the other two, the shoulders. It often indicates a trend reversal from bullish to bearish. I see this currently forming in the BTC daily chart and weekly chart. It may play out to the downside if things keep pace. It would be good to be on the lookout for that one. In combination with major price patterns, the other major signals traders use are price indicators. They are some of the most common ways of gauging price action. The most common one of all is moving averages. These indicators smooth out price data over a specific period of time, showing the average price over time. The two most popular types are the simple moving average and the exponential moving average. Simple moving average treats all data points or prices on a given day the same, while the exponential moving averages gives priority to the most recent price points. For the sake of this example, we will use a simple moving average. The most common way to use them is to have a 50-day moving average and a 100-day moving average and a 200-day moving average. We see that on March 10th of this year, Matic's price nearly hit the 200-day moving average at 94 cents, where it bottomed out. There was a lot of support from previous price points to support that moving average. Also, the 50-day moving average resulted in the topping close on March 18th of $1.23. Lots of traders use that gauge to set stops and profit points. The next price indicator we will cover is RSI, Relative Strength Index. The RSI measures the magnitude of price changes to determine if a stock is overbought or oversold. It oscillates between 0 and 100, with readings above 70 indicating overbought conditions and readings below 30 indicating oversold conditions. We see with Cardano that on March 10th, the RSI was very low, around 30 to 32, and this accurately predicted the low at 31 cents, and then the high that would come on April 15th at 45 cents. The RSI is a go-to indicator for most traders. Used in combination is also the moving average convergence divergence. MACD is a trend-following momentum indicator that shows the relationship between two moving averages of a security's price. It consists of a MACD line, a signal line, and a histogram. Traders use it to identify potential buy and sell signals. We see that on Mana on January 23rd of this year, the MACD line reached its highest point. The MACD line in blue can be used as a trigger when it crosses over the signal line, which happens on January 3rd of this year for Mana. If you had taken that position and sold when the MACD line crossed down on February 23rd, which is the selling signal, you would have made 151% profit. Not bad at all, my friends. Last but not least, let's cover volume. While not a price indicator per se, volume is an essential component of technical analysis. It represents the number of shares or contracts traded during a given period. Changes in volume can provide insights into the strength and direction of price trends. In the crypto market, high volume can be an indication that many people in the marketplace agree the price is fair value, or it can mean there is high exuberance. Low volume can mean the price was pushed up or down by a few people, which is not as strong as market value. For Dogecoin, we see that on January 14th of this year, the price was 8 cents, and the following days, the volume was very low. The price fell. However, eventually the price rose back up to 8-cent mark. A series of high volume candles can be a good indication. Now that we have covered some of the most common patterns and indicators, you may think, when do I buy, when do I sell? That is when strategy comes in and rules to help you make decisions. I will give you a really simple formula with RSI and MACD. Hi everyone. For this example, I have rules that you will follow in like a trading system, and I'm going to use just really basic ones, some of the ones that we've covered. I'm going to use RSI and MACD. The rules are for RSI is that if it's 30 or under, I buy. If RSI is 60 or over, I sell. With MACD line, if it crosses up from the signal line, the MACD line is in blue at the bottom. If it crosses over the signal line, which is in orange, then I buy, and the MACD line crosses down from the signal line, I sell. Really simple rules. Anyone could do this, right? And we're going to start here, and we're just going to see, this is just an example, if this would work, right? Would we make money? This is, we're going to start in July 2022 after the bull market ended. It was way down, and this is not on the peak of a bull run. I think it's more fair that way. And let's just see if it would happen. Let's bring it over. Okay. So we're starting from this corner right here. And okay, our first hit, the RSI is under 30, right? So that's a buying signal, right? I will buy at that point. Change it to green when I buy, right? And then we go a little bit of time. Did it hit 60 here? Nope. Did it hit 60 here? It's 59. Okay, it hit 60 on this day. On this day, we would sell, right? Because the RSI is over. I'll put it in red. Now let's try that with the MACD. Let's see. We started here. So our buying signal for the MACD would be a little earlier. It would be right here. So let's do that. MACD line crosses over. Change it to green. And the MACD, it crosses down here, right? This is when the MACD goes down. Okay. And that's going to be a sell. Oh, come on, MACD. Make that right. Okay. So I'm going to do a number 1 for RSI just for the simplicity of this example. I'm just going to write 1, and then the RSI is, this is 1, and then this is 2. This is 2. Okay. So let's just look real quick. Have we made money if you bought here and you sold there? Would you have made a percentage gain? You would have made 21% on the RSI, right? Would you have made money on the MACD? So the MACD is here, and then we sold roughly here, say here. So you would have made 7.5%, right? So they both made money. The RSI made more money, and you sold both. So now you have a clean slate, right? So let's continue. Let's continue. Okay. So this is just a short example of how good entry points, good exit points, using simple indicators can help you make money. They don't always work out that way. If you kept going for a year, you would have losses. But in the end, through all the times you bought, all the times you sold, you would make money, right? And you would sell at appropriate times. There are a lot more indicators that get used. There's a lot more rules that get used. But this is the idea. You have an Excel file that calculates your profitability. We did with the ruler just to show you. But that's how it works. That's you run a simple simulation, a simple trading simulation, and we saw that the RSI might have made more money overall. But when the MACD performed, it performed beautifully. So now you know what running a trading system is. I don't know why other videos, they don't really show this. They don't show how you would use it. They just present information. And let's move on to the next little part of the video where I give you some of the experience that I've had trading, which is very important. What actually has happened in the trenches. I'm giving you this video that I found. I took many trading courses and I finally got to this. It seems like people, they just present information. They present slides and facts, but they don't actually do this. They don't actually run it for you. This is considered a case study. This is considered a simulation run based on your rules. And people, what they do is they do it for 6 months, and they do it like every day or every week, you know, when the time they set to do it, and they do it for 6 months based on their rules. They run multiple different rules, different trading systems. And at the end of the 6 months, they have a lot of confidence because they've seen it work out. They know in the back of their mind, they know that if I follow my rules, I'll do better. And then if I don't follow my rules, I'll make money in the end, as opposed to, you know, throwing blind darts out there. And you're going to have losses, part of it, but you'll come out on top. And you get that confidence running these trading simulations. So make sure to subscribe to the video if you enjoyed this part. I recommend you rewatch this, and that you find a trading system that takes your personality into account. We didn't set any stop losses, which is another thing that we would have done if it was a real system. We would have had another rule for when to get out.
everything worked out pretty well. We didn't need to get out. We sold at appropriate times, but real trading systems would have a lot more rules and a lot more rules on getting out. And that just keeps you safe. It keeps you profitable.
In my time as a trader, I found that you make money only when you sell, and that at some point, no matter how profitable things may be and how high they seem to could be going, you are best served by selling and making your money now and walking away. If you can make a 5 or 10x from your money in the crypto market, you have done very well. You don't need to do anything else. Most crypto millionaires took the time to learn and implement trading systems and invest at the right time. We can all do well for ourselves and make money. Just don't get too greedy and learn to walk away with a win no matter how appealing the future money may be. You won't regret it. The ones that make millions with barely any knowledge unknowingly got the timing right. They are the exception, not the rule. Don't be disappointed if this did not happen to you. The crypto industry is in its infancy and there is way more to come.